But let me start first by giving you an idea of the scale of the challenge that we currently face. And I have to remind myself to keep on looking down at the camera. I'm not used to this computer, but I have to look also at the slides to better describe what I'm showing you here. So you can see that between January 2020 and up to just few days ago, June 2020, we had this kind of a major dip in prices. So oil prices in the big first months of this year were trading just above $60, so between $60 and $70 a barrel. And then the crisis started to unfold in March, partly because of demand collapse, but also producers opened the taps. And here I'm talking about OPEC and OPEC Plus and OPEC and its new partners since 2016, which came together to kind of support prices and put upward pressure on prices. But in March this year, they failed to reach an agreement, and then whatever restraints they had in place, they kind of let go. So a combination of a falling demand, and then later realized how bad the situation was, plus oversupply in the market led to this kind of massive dip that you can see in front of you in the months of April. Interestingly, in April, what the industry saw for the first time, at least in its modern history, is negative WTI prices. Now, after that, OPEC Plus came back together and they agreed to introduce unprecedented cuts of 9.7 million barrels a day, which is roughly 10% of total supplies. So they said they would have that effective as of the 1st of May. So that's why we saw this kind of recovery in prices, and it seems to be staying with us. However, in June, the recovery seems to have paused. So we did not have this U-shaped curve to say that we had a continuous recovery. So we had the recovery from a very low base in April, but things seem to have stabilized in June, and oil prices have been hovering until today around $40 a barrel, give or take $2 a barrel either side. So that's one thing to keep in mind with respect to where we are today in terms of prices. But let me also show you the scale of the crisis in terms of demand. Because once we understand the scale of the crisis, you will have a better understanding of how the recovery might look like. And when you look at all these numbers, the massive numbers that I'm going to share with you, perhaps you might be better convinced that it's unlikely that we see a kind of V-shaped recovery where things will go back to normal at the end of the year or early next year. I think the current crisis, the impact of the current crisis might stay with us for the next few years. But here is the demand forecast, and I looked at the three commonly quoted energy forecasting agencies. So we have the International Energy Agency, IEA, OPEC, and the US Energy Information Administration. And you can see how they had different views in April, because in April the data started to come to us. So it took us a while to understand the kind of demand destruction that the world was witnessing because of COVID and because of the lockdowns imposed that kind of sent the global economy into a coma. So it put the economy at a standstill. And with that, the transport sector was directly affected. And the transport sector really means oil demand, because in the transport sector, oil is king. So it doesn't have really many direct or immediately threatening substitutes. So you can see in April how there was some serious numbers coming in, but there was divergence between the numbers. May and June, has been convergence in the numbers, and the scale still is massive compared to the April forecast, at least for the IEA. But you can see that they are roughly expecting on average a demand destruction of roughly 8 million barrels a day for 2020. Now, for those of you who are familiar with the oil industry, these numbers will be quite alarming, because in the past, whenever we were talking about a demand destruction of 500,000 or 1 million, we would have been really concerned. And here we're talking about on average 8 million barrels a day of demand destruction. That is a lot, and that is going to take a while to be restored. Now that is on the demand side. On the supply side, we also saw an unprecedented alliance. I don't like to use the word alliance because of, if some of you have legal background, you might criticize me for that, but let's say loosely the term alliance or partnership or deal or agreement, to put it better. And I mentioned earlier OPEC Plus. So OPEC Plus came together in 2016. It was 2 years after the financial crisis of, after the oil price collapsed in 2014. And they had together perhaps much longer than they would have wanted or what many people expected. But then what happened this year, the scale of the crisis, scale of the demand destruction, not only brought back OPEC Plus together, because in March we saw this kind of deal was over when the Russians walked out of the meeting and they said, no, we're not going to introduce further production cuts at the request of OPEC, because Russia, if you want, leads the non-OPEC partners within the OPEC Plus partnership. But then, because of the unprecedented scale of the challenge, OPEC Plus came back together, and then they agreed to take out of the market 9.7 million barrels a day. But that was not the most, I would say, interesting aspect. The more interesting aspect, in my opinion, is that for the first time, we saw a much bigger group led, if you want, by the US, joining forces with OPEC Plus to put further the lid on oil production. And here I said it's more interesting because USA, until very recently, has been or had been a strong voice condemning OPEC and its attempt to manipulate prices, and it would call it openly a cartel. But here we have a new condition that forced the US to move 180 degrees and reverse its position. And then President Trump said 2 months ago that now he loves OPEC, and then because OPEC has changed. Well, actually, OPEC has not changed since the beginning of since the foundation of the organization in 1960. And until today, they have a clear target, clear objective. But it is the US which has changed because it has become just the largest oil consumer, but also the largest oil producer. So there was here an additional interest to bring these producers together. However, I should clarify that the US and other players outside the OPEC Plus agreement, they did not make any formal commitment to cut production, but they said that they were going to cut, the production is going to be cut in response to lower prices. So as you can see, we had so far seen 3 things which were unprecedented in the industry: the negative prices, the scale of the demand destruction, and the scale of the production cuts, and the group of countries that came together to salvage the market. Now, the problem here is that not all producers are exposed to the same vulnerabilities when it comes to prices. So that's one thing to bear in mind. You have some economies are, of course, all producers have suffered from the crisis, but the degree of suffering is not equally shared across various producers. And the easiest way to understand this kind of issue is to use the fiscal break-even price, which tells you what kind of oil price some producers need to balance their budget. And as you can see here on this figure, countries such as Nigeria are in serious trouble because they need an oil price of above 120, so maybe $130 a barrel. And then Russia less so, because they managed to introduce some serious macroeconomic reforms in 2014 following the collapsing crisis and the imposition of sanctions on the Russian economy because of the annexation of Crimea. But I mean, just this simple figure gives you an idea about the challenge that producers are facing. And they are now, of course, concerned about salvaging their revenues. So the more dependent a country is on oil revenues, the more we're going to see things moving in one way or another. And I'm going to explain to you in a minute when it comes to the oil industry. But something is going to happen because they are desperate to salvage their oil revenues and as a result, salvage and support their economies. And we're going to see also how this varies as well with respect to what happened before the crisis. So we look at the last few years in terms of investment, in terms of production in the particular country. So if they were having problems before the current crisis, then what the crisis did to them is amplifying existing problems. So whatever pain they were experiencing before, now they are experiencing a multiplier of that under the current circumstances. And usually, whenever there is a change in domestic or international markets conditions, we see governments changing their kind of relationship with investors. So that's why whenever there is, like when I looked at this incident today, this crisis, the collapse in prices, the collapse in investment, then I could tell that there would be, that the situation as it is, whatever we have in terms of government investors relationship is not going to remain still. It's going to change because traditionally several factors affect this relationship, and it can go one way to another. In this case, I tilted more the balance towards a more welcoming attitude towards investors than a tougher attitude towards investors from the side of host government, because this is, I mean, the current reality tells us this is going to be most likely the situation in the coming months or years as the situation unfolds and the industry recovers. So here, allow me if I just show you quickly, and I referred mainly to the tax burden because the tax burden translates into financials. So when companies are cutting on their expenditures, they are trying to minimize the cost of doing business. And the fiscal regime affects directly the cost of doing business in a certain country. It also affects government revenues from the industry. So you can see, for example, if prices fall, if the investment falls as well, if production falls, or there is exploration activity falling, players exiting the basin, or the basin hit maturity and production has been in decline, or a country is more dependent on import bills, or they are more concerned about security of supply, then these factors together tend to incentivize governments to relax their fiscal terms, to make it more appealing to international investors. The opposite happens when you have a period of high prices, rising prices. So we saw what happened in the first years of this century, when prices were rising rapidly. Many governments rushed to tighten their fiscal terms because they felt that companies were desperate for opportunities. And we saw many governments introducing new taxes, other governments tightening their fiscal terms, and other governments moving into more nationalizing their industry, as we saw with Venezuela under a late President Chavez rule. So oil prices are, for me, the most obvious factors in terms of driving changes in the relationship between host government and the investors. So that's why what we have today should be sufficient to make some changes to that relationship. But add on top of that, if you have a booming investment, if the industry is making very encouraging statements, if the industry is perceived as harvesting high profitability from the industry, climate change policy, and I'm going to touch on that later on, but it's more of a longer term issue. If the country suffers from cost overruns because of the project, etc., politics will also play a role. So if you have more of this list of factors, then you should expect the government relationship with the investor moving towards tightening the screws on the investors. So what's happening today, and it's not just today. So again, of course, the crisis is important to capture our focus, but to have a better understanding of where we are today and what will happen next, it is useful to look at what has been happening in the last few years and not to lose sight what has been happening particularly in the last 10 years. And that's why I shared with you this slide, which portrays oil prices between 2011 up until 2020. So you can see that actually since summer 2014, the oil industry entered a lower oil price phase. So it's not just now it's of course much lower, but the industry compared to the first years of the last decade, so between 2011 and 2014, oil prices were hovering around $110 a barrel in nominal terms. But that situation changed after 2014, largely because of the shale revolution in the US, which brought into the market new supplies, not only in terms of scale, but it was more in terms of flexibility. And because shale responds faster to changes in prices than conventional oil. And so since 2014, we have been in a lower oil price phase. Of course, there were some periods where we had some short spikes in prices, but nothing compared to what we saw in the previous years. And then came the crisis, and you saw how prices collapsed we're within that already lower band. And I wonder whether for the next few years, I should set a new band which shows even a lower scale for oil prices to where they would be fluctuate, and only time will tell. So that's one thing to keep in mind. But oil price is, as I just mentioned earlier, is the most obvious factor in driving the relationship between host government and the industry. And I took this example from the UK continental shelf, or the UK North Sea. And you can see here the oil price and how the UK government tried to introduce or increase or reduce the rate of a new tax that was introduced in 2002, and it's called the supplementary corporate tax. And it's an additional tax that the government introduced on the industry at the beginning of this century when prices were recovering. And you can see how, as prices increased, the government doubled that rate. Then again, after the dip in prices, short dip 2008, 2009, this rapid recovery in prices led to the government further increasing the tax rate. But after the collapse in price in 2014, as it became more obvious for governments around the world that we were not going to see the high levels that we witnessed in 2011, 2014 for a while, then we saw governments around the world, but here the UK in particular, reducing their fiscal terms. And you can see how they went back in 2016 to where they were in 2012. So there was a kind of pendulum swinging. It took a while to move from one side to the other. And therefore, I can easily say that as long as the current prices remain where they are, even if they recover a little bit, but if they don't go back to where they were over the last few years, then it's unlikely that we're going to see like tightening of the terms. We're going to see, on the contrary, more relaxation of the terms based on oil price alone. But of course, that may not be enough. There are other factors that we should take into consideration. And such factor, and excuse me, I have a problem here with the slide showing this duplicate. So let's ignore this top of the slide. But you can see here on this figure, the scale of the collapse in investment spending that was announced by oil companies around the world. So we have here the global figure and here more by operator, but the numbers are mind-blowing. We're talking about at least 20–25% of whatever companies plan to spend this year has been cut. And there will be some recovery in the coming years, but you can see at least not before 2021 or 2022 that we would go back to the level of activity that we saw in 2019. And again, you can see here the different kind of companies cutting on their investment. Now, the problem with cutting on investment, it's particularly for projects which were awaiting final investment decisions. So usually it's exploration and projects that were about to be developed. So this is where we see most of the axe falling, but there are additional repercussions in terms of employments, and there are thousands and hundreds of thousands of people around the world that have lost their jobs. So that also adds to the financial burden to governments as unemployment rates increase. Now, we can see here an example from the where investment was heading before the oil price collapsed. And if you look at the crisis 2014 to 2016, where we saw the collapse in price, what we were saying actually that companies' portfolio has been changing. So it has been going to areas where they would secure tighter or faster payback. And this is where lots of money went into shale in terms of investment spending, whereas offshore conventional oil has become less and less appealing to investors, and conventional kind of was stable in the last few years. And this is why in the study I did recently, we focused on offshore provinces, because if you were to see the massive impact of the current crisis in terms of investment for the coming few years, I think offshore would be would best illustrate the situation, because with offshore you have usually higher costs in terms of investment spending, and also operating costs, but also the payback period is much longer. So, and companies, when you are dealing with this level of uncertainty, of course, they would invest in projects which generates faster payback period. Now, so I talked about oil price, I talked about the investment as affecting companies, the relationship between host governments and the industry, but there is also the stage at which the production was in a certain province before the crisis hit. And among the 10 offshore provinces that we selected, we all, as majority, 80%, actually 2 out of 10 only. So we're seeing an increase in production. That's where Ghana and Brazil, but everywhere else with these provinces, they saw a peak in production and then a decline in production, which for some, because of less discoveries were made, but others because, again, less investment was made. But this is an example of the UK and Norway, and you can see how governments also react to changing nature of production in their province, and they tend to relax their fiscal terms once a province moves from the growth period and peak into a decline. Now, these are the provinces that we have covered, and you can see that most of them, they have a kind of peak in production and then decline, except for Brazil and Ghana here in this line. But other provinces such as Angola, Norway, Australia, Indonesia, UK, Mexico, US, Gulf of Mexico, Equatorial Guinea, and Nigeria, they all saw their production stalling and their growth is turning negative year after year. So we already have an idea that which countries might do something to salvage the industry, because some of these countries that I already mentioned, including Nigeria, including Angola, they either they took steps before the crisis to make their country more attractive to investment, or they were revising their terms to make investment more attractive and increase production in their countries, such as the case in Nigeria. And another thing about these countries, which will make you think about the long-term impact, is that they are sitting on certain reserves, proven reserves of oil. I'm not saying that they are running out of reserves, but under current production trend and the proven reserve scale, they have an average reserve to production ratio of 15 years, but that also includes Nigeria, I think, which has an RP ratio of 50 years. Now, this makes you think, I know, and I'm going to talk about later about the climate change policies, that these governments, first of all, they are running substantial fiscal deficit, and they are struggling in terms of attracting investment before the crisis, and their production has been declining before the crisis. And now they are facing a situation where oil prices have collapsed. They are recovering, but they are still less than 40% the levels that we saw earlier this year, and there is no certainty whether they will return sustainably to the levels that we had in the last few years anytime soon. And governments are also suffering from companies cutting down significantly on their investment spending. And as such, and they have these reserves in the ground that they want to turn into money, into financial wealth to sustain their spending pattern today and hopefully future generation. So all these put together kind of tell me that the direction that we should expect to see in the coming months and year at least is towards a revisiting of the cost of doing business in the country. And I'm saying cost of doing business, not just fiscal terms, because some governments actually may not think immediately of the fiscal terms, not because they don't believe that their fiscal regime needs changing, but they will apply regulatory changes because regulatory changes don't carry any financial costs. So they will do that first, and then they would revise their fiscal terms if the investment climate doesn't invest. And this is just also a quick picture to show you that news, the different the reaction is going to be to the current crisis, and I'm going to show you how in a minute. So first of all, the main finding of the investigation that we did comparing the offshore provinces is that we should expect fiscal changes whenever prices change drastically, whenever investment change drastically, and production trends change drastically as well. There are other factors that should be captured in the discussion, but of course they don't carry the same weight. And here I talk about the dependence of an economy on oil revenues and the neighborhood effect. So what your neighbors are doing tends to affect the policy direction that your own country will take. And politics also play a role. I mentioned earlier President Chavez in Venezuela. His arrival opened a new chapter in the industry's history. But also, I'm also thinking about Mexico, where the current president just was not terribly happy with the performance of the industry after he came to power. Whereas in Angola, we have a new president, I'm saying new, like over the last 2 years, who was elected in 2017, and he came with a different mindset. So that also plays a role, but on its own, it's not sufficient. It has to be backed up by other factors. That's why I say that if they play a role, but it's a little bit more muted. Then we found that we should expect a certain direction of travel in terms of the need for governments to do something to support a struggling industry and salvage their investment, production, and revenues. However, the speed at which governments are going to respond is not the same. So some countries are going to be faster at introducing changes. So we saw already Norway coming up with a new fiscal package to support the industry, even if temporary. But usually governments tend to be slower in terms of responding to oil price decline, then they respond to oil price increase. So when prices increase, they tend to tighten the screws on the industry fast. Whereas when prices decrease, they know that they will have to change perhaps their fiscal terms, especially if their fiscal terms are not profit related, but they are not going to jump on that. They keep on waiting, hoping that the crisis would finish quickly and prices are going to recover quite fast. So we saw this kind of asymmetrical response of governments towards oil prices. And as I mentioned, that governments tend to reduce their regulatory burden first before they implement financial measures, because again, they carry less financial cost. And we saw this already with Equatorial Guinea, which adopted some relaxation of its exploration license rules to give companies more time before the license, for example, is subject to renewal. And other countries simply said, we're not going to hold any licensing round this year. So whatever they planned for this year, they decided to postpone it for the foreseeable future. Some for next year, others left it indefinitely. Another important factor that we found playing a role is a dependence on the economy. And this is where we felt that the more a government is dependent on oil revenues, the slower their reaction is going to be to the current crisis. Again, because this is the sector that generates most of the revenues for them, and it's not easy to simply relax the terms and feel that you are foregoing some of those revenues, even if they are overall lower because of lower oil prices. Now, some governments already started to review their fiscal terms. Unfortunately, I don't have the time to go through all the details, but wherever that review happens, such as in Angola, I wouldn't expect them to rush now to introduce more drastic changes. So in Angola, for example, the tax rate for marginal fields was reduced by 50%, so it was halved. I doubt they might do something as drastic now, but they will continue in the same mindset in terms of reducing the burden on the oil companies. And then finally, what is very important, because in some countries, and I know that companies will not do this openly, but in some places, including in the US, some companies were calling for government bailout as the government was bailing out other industries. In my opinion, this is wrong, because the industry does not need any bailout. But what governments can do, which can be much more powerful than any bailout, is to adjust their fiscal terms to make the regime more competitive, internationally more competitive. Because that, in my opinion, can have longer term effect, in a sense that, first of all, governments, and when prices are low, they tend to compete for international capital, because capital becomes scarce, and governments are competing with other countries for this capital. So they want to devise a regime which will make companies get into their own country and then generate the investment required to support production and revenues. So this international competition for capital will drive governments to work or to consider devising competitive fiscal arrangements. And here particularly, when I refer to the more a regime is profit-based, the more attractive it will be to the oil companies. Never mind the tax rate. So usually I say a competitive fiscal regime is not one which has necessarily low tax rates, because typically a regime which has low tax rate is not stable. What happens is that these tax rates gets revised upwards as soon as prices recover, or as soon as there is a discovery in the country. And there are many examples around the world of this, such as Guyana or Israel, for instance. But when you have a regime which is profit-based and internationally competitive, then that regime will adjust automatically to changes in market conditions. So you don't need to go and do all sorts of tinkering manually to adjust to changes in conditions and to adjust to changes in prices, particularly as we have today. So this can be an opportunity for governments to make their fiscal terms more attractive for investment, because even if today they may forego some of the much needed revenues, but this can also mean more revenues in the longer term. And allow me to conclude at the end by looking beyond the current crisis, not just the next 2 years. And I know this means that I would be engaging in coffee reading, because in my country where I come from, Lebanon, we tend to read the fortune in the coffee cup. So, but the first main factor, I would say the dominant factor when we talk about the longer term, is the question of climate change and what governments were expecting from the oil companies before COVID-19 happened. And here I took this, these numbers from the IEA and early publications that they, I think they published, they launched earlier this year in January, so before the COVID-19 crisis became so overblown. So you can see that there was a kind of criticism for the oil companies, the oil majors, that which says between 2015 and up to 2019 or 2020, just less than 1% of the total capital spending by these oil and gas companies went into green energy projects. Now today, I don't know if it's going to get worse or it's going to get any better, but again, link it to the investment cuts that companies have announced as a result of COVID-19 crisis. So companies are going to be poorer, and governments are going to be poorer, and consumers are going to be poorer. So that will make us think about how aggressive or lenient climate change policies are going to be post-COVID. I hear different stories depending on where you are sitting in the world. So if you're sitting in the developing countries, if you're sitting in sub-Saharan Africa, you don't hear the same attitude towards climate change policies post-COVID as you do when you are sitting in Europe, for instance, where the tone is much more aggressive. And one thing that comes to my mind, which is going to get even worse at this stage, is the rising income inequality, which was even more pronounced before COVID-19. And we saw how by increasing the prices of, let's say, gasoline and diesel, the fossil fuels cost on people, this led to all sorts of protests around the world, from the Middle East to Latin America and to Europe, including Paris with the Gilets jaunes. And this situation is going to look even more drastic today because COVID-19 is making lots of people poorer. Now I'm going to skip this slide. And at the end, you know, we can all engage in a guesswork in terms of the long term. My presentation was unapologetically about the short-term reaction to the current crisis, how the oil price, investment, and production trends are working together to drive governments in a certain direction when it comes to their relationship with investors. So I'm expecting to see more lenient terms announced, whether fiscal or regulatory or both, around the world, but they would be more pronounced in countries which were struggling before COVID to attract investment and to sustain production. And I prefer not to engage in terms of in a discussion in terms of what will happen in the very long term, because I want to share with you a big something from the first decade of the century, where many people believed that the world was running out of oil and that oil prices were headed to even $200 a barrel. and lots of books were published on this subject. And where are we today? Instead of swimming out of oil, we're swimming in oil and into oil. So that's why we have to be careful when we're talking about any forecast that take us beyond 5 years or even further, 10 years, especially